All right. Today is Monday, May 17th. This is a recap for the stock market activities today. Initially, the sell-off resumed today, specifically in the technology sector and the high multiple names. Yet at the end of the day, the indices managed to close well above the lows of the day. And we also saw yields bouncing higher again in the morning right after the Empire State Index was out. And the most important take for the Empire State Index is the following. Prices continue to rise higher. The index itself was actually below the reading that economists were expecting, but prices continue to rise higher, signaling more and more inflation. The prices paid index rose 8.8 points to 83.5, while prices received rose 2.2% to 37.1, and that is the important take. The market is still battling whether to believe the data suggesting that inflation is getting out of hand and the Fed is sleeping, or the other narrative that inflation is indeed transitory, meaning whether the market will believe the Federal Reserve or not. What do we have in the economic calendar this week? We have the FOMC minutes, and in my opinion, tomorrow will be another boring day for the market with low volume, and we know during low volume, the path of least resistance is higher. So perhaps tomorrow we will see a continuation of the oversold bounces and some dip buying. But all in all, the market should be flat, awaiting the FOMC minutes. We will also get more economic indicators this week. So the market is debating what is the next trajectory. The market is leaning toward the fact that inflation is rising higher, and it should follow the inflationary book for appreciating yields, appreciating financials, materials, commodities, industrials, energy, and some defensives, while fading away the high multiple names and the technology sector of the market. But it's a battle. On one hand, you get the CPI data signaling higher inflation, way higher than expectations. And this is the CPI, by the way, aka the CP lie with all of the cooking. On the other hand, you get the retail sales data, for example, which was flat month to month, perhaps suggesting that the inflation will not last for too long. It was a direct result of the stimulus. In the meantime, we as investors and traders also have to make up our minds. We have to gather all the facts and decide on which playbook we are going to follow. We talked about dip buying versus oversold bounces and the checklist you need to go through before deciding whether to trade or to buy the dip. And options in times like these are your best friend. Because remember, the main purpose of options and derivatives in general is to de-risk, not to be a moron and buy way out of the money calls or puts expiring this week and expecting that you're gonna score big. That is gambling. That is worse than buying a lottery ticket. The main purpose for options is to remove the commitment from your trading and investment decisions. You buy a call, you sell a put, and you are telling the chart, and the market for that matter, prove it to me first before I commit the capital. For example, you buy a call out of the money slightly with enough time left. And if the stock indeed closes above the strike price by the expiration date, now you have your answer. Your theory is validated, and you have the option whether to take profits or to exercise into buying the stock. Enough said. What is my outlook regarding inflation? I believe that the Federal Reserve is underestimating the risk of inflation. They continue the propaganda playbook by saying that they're not thinking about tapering or raising interest rates because they need to see more data regarding inflation. And inflation will be transitory. And even if it's not transitory, we got the tools. And by tools, by the way, they mean tapering and raising interest rates. So this is a childish game played by the Federal Reserve. So the FOMC minutes will be very important because we know Jerome, Papa Jerome, the propagandist that he is, will continue to play the same playbook. But what about the other members? And here is another thing to think about. Some of the most powerful deflationary forces in the last decade at least, China, Amazon, and technology. The game has changed. And you're not going to hear this narrative, by the way, in any other channel or from any other quote-unquote expert, economist, jagoff, doesn't matter. What matters is the following. China used to be the biggest source for deflation. Cheap labor, enormous supply chain, fast production, cheap shipping, but the game is changing. China is now hiking wages, making it more expensive to produce goods in China, and the shipping costs from China are skyrocketing. Furthermore, since China recovered from the COVID-19 crisis early, and I say recovered lightly, their demand resumed quickly, overwhelming the global supply chain for other goods that China imports. China is a huge importer of commodities from the United States, South America, and the European Union, while the Chinese demand continues to skyrocket for lean hogs, corn, oil, copper, you name it. The global supply chain, at least in the United States, European Union, South America, other Asian countries, has not recovered yet, and the supply chain has a lot of catching up to do. And therefore, you're seeing the prices of commodities and prices in general rising higher because China has now become a source of inflation. Furthermore, Amazon for too long has been a source for deflation. Cheap goods underpricing the competition, and they show up at your door in 2 days or less. But here's the problem. Amazon is also changing to become a source of inflation, not deflation, specifically wage inflation, because there is this war, this e-commerce war, and to win the war, you have to attract the most talent. You have to hire people, and therefore Amazon is offering more incentives, higher wages, and that is adding to wage inflation. If Amazon raises their minimum wage, their benefits, so will Target, so will Walmart. They have no choice but to do so. And of course, what about technology? Technology remains a deflationary force in speeding up the supply chain, production, and automation of jobs, therefore pressuring costs down. There is a flip side to this coin, however. Technology, specifically social media platforms and the likes, enabled a new generation of workers to have alternatives, to have multiple streams of income, working in the gig economy, being content creators, opening Etsy stores, and even the story about Megan Plays. I don't know, it sounds dirty. You'd think it's OnlyFans, but it's actually for Roblox. She actually plays. She plays video games. But whether it is Roblox or OnlyFans, doesn't matter. You have a new generation of workers who have lots of alternatives, and that in turn forcing employers to hike wages and benefits. So a lot of things that traditional economists are not paying attention to, specifically those in the deflationary camp, the inflation deniers, the transitory believers, but these are the blind spots that we have to pay attention to. And there are many more than this, by the way. Anyhow, back to the market. All in all, quiet day. We saw some sell-off across the board, specifically in the technology sector, but certain oversold names, the likes of Palantir, for example, held steady and closed in the green. But the most important stock this week, and it's shaping to be that way, is Tesla. Not only due to the news we received during the weekend of Elon Musk pumping and dumping Bitcoin. So there is a backlash and there is a slew of bad news regarding Tesla. But Tesla's becoming a pulse for the sentiment. It used to be the hottest stock in the market. If investors are starting to change the sentiment from positive to negative, perhaps taking profits in this name, pushing it lower, Tesla will act like an iceberg and it will take down a huge segment of the market down with it. So we are watching this name very closely, and we will talk about that during the options and the technical analysis. But for now, I got a market to cover, so let's start with the market performance today. And here we go. The Dow Industrial Average closing in the red, down 54.34 points or a decline of 0.16%. The Nasdaq down 50.93 points or a decline of 0.38%. The S&P 500 also in the red, down 10.56 points or a decline of 0.25%. What about the sector's performance? Leading the pack at number 1 and capturing the gold medal, energy. At number 2 for the silver, basic materials. At number 3 for the bronze, consumer cyclicals. The laggards of the day led by utilities and technology, two sectors that are sensitive to interest rates rising higher. And the two sectors leading the market happen to be inflationary in nature. And by the way, that goes back to the same theme we've been discussing for a while between dip buying and oversold bounces. A lot of names in the technology sector and the mania names will have huge bounces due to oversold conditions. Those are likely not going to be sustainable. But the dip buying in energy and materials, industrials, defensives, financials is likely to be more sustainable. What about the market breadth? The advance to decline ratio. NYSE 52% advancing versus 46% declining. The Nasdaq 52% advancing versus 45% declining. All in all, boring day, pretty much cut down the metal, waiting for more data to process. Moving on to futures. What's going on here? They've been talking about the death of commodities, the correction, and it's over, and inflation is transitory. Hold your horses here because the conditions, the demand for commodities has not changed. The demand remains hot, specifically from China. And here it is. Big gains for crude oil of about 1.5%. What about softs? Gains for cocoa, OJ, coffee, and sugar. Meanwhile, the pain in lumber continues. We're seeing a massive correction here in lumber, and we're seeing proxies for lumber, the likes of Home Depot and Lowe's, also getting whacked. But Home Depot is reporting earnings tomorrow, and that will give us a pulse on the demand for lumber and the health of the housing market. We also have some housing data coming up tomorrow, so we could see a short-term bottom here for lumber, perhaps an area from which lumber futures start to rebound, depending on the earnings from Home Depot. We also saw modest declines here for cotton futures. What about metals? The charts don't lie. Silver and gold, huge day to the green, and pay attention here. Gold and silver rallying hand in hand with copper and yields. Very important. We also saw gains for platinum, meanwhile muted activities for palladium. What about meats? Feeder cattle futures leading the gains, meanwhile muted activities for live cattle and lean hogs futures. What about grains? We're seeing rebounds for certain names. Canola up big today. Soybean oil rebounding again, and corn also closing in the green. Soybean futures flat for the day. Meanwhile, the declines in grains futures led by oats, rough rice, wheat, and soybean meal futures. Watch out for oats futures because we're seeing a nasty correction here, and perhaps there will be an opportunity to play a rebound by opening some contracts, playing a short-term bottom. Moving on to the big casino, the options market, and the casino is dead. No activities at all. Quiet, no action, boring, you name it. We need some action here. We need to spice it up a little bit. Let's hope that Papa Jerome slips somehow, says something he's not supposed to say. We get some action here in the options market. Because for now, it is a ghost town led by Tesla, number one, with about 700,000 contracts. About 55.5% of those were calls. Watch out the options volume for Tesla. If it continues to rise higher, specifically to the downside, meaning more puts than calls, we could see more pain for Tesla, but that also will be an indicator. Suppose Tesla drops 10-15%. In addition to the pain it has already suffered. If the bears start to pile up all of a sudden aggressively, and we know the big short, of course he shorted a while ago, so he is swimming in cash right now. His Tesla shorts are paying off. But suppose the Johnny-come-lately bears start to pile up on Tesla, and you see the put-to-call ratio increasing significantly. That will also be an indicator for a bottom in Tesla. At number 2, Apple, with a little over 670,000 contracts. About 62% of those were calls. At number 3, AT&T, we had the deal about the merger between Discovery and Time Warner Media, whatever it's called. AT&T was up in the morning, but finished to the downside. A huge reversal in AT&T, Discovery, and even Viacom. Still, it was one of the hottest names today with about 570,000 contracts. About 72% of those were calls. But the hottest names, relatively speaking, is AMC. The gamma squeeze goes on. We're seeing aggressive call buying for AMC, way out of the money, short term, and that is forcing the shorts to cover quickly. So watch out for this name, AMC. How do we know that AMC is topping? When the mania gets out of hand, when you see the put to call ratio diminishing significantly, that will be a sign that AMC will reverse. But we're getting close here. What about the unusual trades for the options market today? What about the ticker GDX? We have two trades here because this is a spread, a bullish one. GDX is the gold miners ETF. In this case, they're making a bullish bet by buying the 43 calls and selling the 49 calls, expiring July 16th. And they are expecting the GDX to rise all the way, but not over 23.5%. They paid $1 for the 43 calls and they collected 25 cents by selling the 49 calls. All in all, the entry cost for this trade is 75 cents a piece, and that brought the total all the way to $1.5 million. What about the trade for the ticker DUK for Duke Energy? This is an interesting one because it's a utilities name. Utilities suffer when interest rates rise higher because utilities act as a substitute for yields. When yields go down, as we saw during the deflationary period, utilities come in favor as a replacement for solid, reliable yields. Now that yields are rising higher, all of a sudden utilities are not so hot so. But here we have a bullish bet for Duke Energy, buying the 110 calls, expiration date June 18th. With expectations that the name will rise over 7% by then, they paid about 50 cents a piece to enter this trade, all in all bringing the total to about $700,000. What about the trade for the ticker TDOC, Teladoc? We talked about this name yesterday. It is severely oversold. It is due for a big bounce. We saw some of that on Friday, but again, today was an opportunity. If you wanted to execute that oversold bounce rally and play it, today was your opportunity. And here's a trader taking advantage by buying the 145 calls, expiration date May 21st. Meaning this upcoming Friday. This is very smart because they're playing the bounce. They know it's a bounce. They know it's temporary. Perhaps there's more pain for Teladoc to come, but for now, the name is extremely oversold. They're expecting the name to rise over 5.5% by then. They paid about $1 a piece to enter this trade. All in all, they paid $850,000. And by the way, let's stop here for a minute. There are two ways you can be an opportunist and play what's going on in the market right now. You can chase the oversold bounces, or you can wait for the bounce to happen, watch your technicals, and once the bounce is already exhausted, you jump on the bear side. Now, there are pragmatic traders like myself who plays both sides. I don't give a rat's ass where the market goes. I want to make money. That's my objective. My sentiment is one thing, but the way I play the game is a different thing entirely. What about the trade for the ticker WDC, Western Digital? I remember my tickers. I don't need to Google them. I can win the tickers championship. Anyway, the name rallied higher today along with other memory names. And we will talk about Seagate in a second, but Western Digital caught a rally today, and they are attributing the reason for the cryptomania, at least in China. And they call themselves crypto farmers. That is different from crypto miners. Anyhow, both of these terminologies are stupid because are you really mining with a hard hat and diving into a cave? Are you really farming with a sun hat, kneeling and picking up cotton? Give me a break. You're just sitting on your ass looking at a computer screen. Anyhow, WDC, they're buying the 95 calls, expiration date June 18th, with expectations that the name will rise over 24% by then. They paid about $1.40 a piece to enter this trade. All in all, bringing the total to about $840,000. Continuing with interesting trades. What about the ticker TSLA for Tesla? The bears are piling up here. They're smelling blood and they're heading. This trader is buying the 530 puts, expiration date May 21st, meaning expiring this week. And they are anticipating that Tesla would drop over 8% by then. They paid about $3.50 a piece to enter this trade. All in all, bringing the total to about $1.8 million. And if you're going to bet against Tesla, might as well bet against the RKK for Tesla witch Cathie Wood. It's the same thing. If Tesla goes down, Cathie Wood goes down. And in this case, they're buying the 88 puts, expiration date June 18th. With expectations that the name will drop over 15% by then. They paid about $1.75 a piece to enter this trade. All in all, bringing the total to about $875,000. Lastly, what about the ticker STX? We talked about WDC. Here's STX for Seagate. They're buying the 130 calls, expiration date July 16th, with expectations that the name will rise over 25% by then. They paid about $2.90 a piece to enter the trade, all in all bringing the total to about $1.45 million. Moving on to the heat map analysis, and let's see what we can extract from the action today. Right away, the weakness is evident in the technology sector, with few exceptions. We have the oversold bounces in certain names like Palantir, Snowflake, etc. We also have the overperformance from Amazon and Google when it comes to big cap technology names. But yet again, the bigger and more evident theme in the market is the inflationary theme. Take a look at energy, take a look at materials, take a look at financials. They're performing just fine. Regional banks up big today. The big banks also doing okay. You have energy, ExxonMobil up over 2%, Chevron up over 1%, gains across the board. Likewise, we're seeing a rebound in materials, specifically in copper. FCX, Freeport-McMoRan, closing with gains of about 4.5%. And it is important when gold and copper go in the same direction. Very important. There is a divergence here, but it could be a signal for something bigger to come. It could be a signal that inflation is indeed rising higher. Copper is the healthy indicator of inflation, meaning inflation in itself is not really that bad because the initial stages of inflation are very good for the economy. Bad for the stock market, bad for the high multiple names, but very good for the economy. And copper goes higher when we see inflationary action in the economy. But if gold also starts to rise higher, in times like these, it also tells us that perhaps there is worry underneath the surface of the market of people resorting to buy gold and silver as a hedge for the later stages of inflation, the ugly stages of inflation. Anyhow, back to the heat map. The healthcare sector, the drug manufacturers remain the safest spot to park in this market, for now at least. Another important take here is for the automotive manufacturers' stocks. We know the unique circumstances going on with Tesla. The tide is turning, the sentiment is changing, so Tesla is the exception here. But take a look at the names that got beaten down significantly. We're talking about the NIOs, the Xpengs, Li Auto. All of these names are capturing oversold bounces. But here is another take. Ford closing the day with gains over 2.5%. General Motors pretty much flat. The reason is Ford already went through a correction right after earnings, down over 10%. General Motors, on the other hand, never really went through a serious correction since last year. What about the themes analysis? What's going on here? Starting with the reopening trade. They are starting to fall out of favor. Not entirely, but the names that ran really high since the November election of last year are being questioned. The market is looking at the earnings, the market is looking at the reopening, and looking at the stock price and evaluating whether the stock should be here or whether the stock already went ahead of itself. And you have Morgan Stanley's Mike Wilson, the genius that he is, predicting a 10% correction every 2 weeks or so. Anyhow, he is saying that the reopening trade will be out of favor and the inflationary trade is the one to stick with. So let's check on the inflationary trade and see what's going on here. Mixed picture, but it looks a lot better than the reopening trade. So perhaps Mike Wilson is into something here. Of course, we can go back and forth and debate which names should be under the inflationary trade. That differs from person to person, but the consensus is that financials are inflationary, materials are inflationary, steel, copper, aluminum, agricultural stocks, etc. Likewise, industrials in general are inflationary stocks, defensives, energy, because the driving forces for these names to rise higher, unlike, say, technology, where the monetary policy, the printing, is what drives the prices of high multiple names higher. If we are heading close to tapering, whether it happens this year or next year, then the catalyst for these names to rally higher is gone. But the catalyst for the inflationary trade will remain with us even after the monetary policy is tapered. And the reason is that the driving force behind the inflationary trade, let's say specifically for infrastructure stocks, the driving force behind them is actually the fiscal policy. Remember, the spending hasn't even started from the fiscal side. They will spend trillions and trillions of dollars, and these stocks related to infrastructure will benefit tremendously. What about the disinflationary trade? What's going on here? The high multiple names not doing so hot so. We're talking about Tesla, ServiceNow, DoorDash, Square, Peloton, but not a bad down day all in all. And the question is, has the selling dried out already? And what would that mean? Let's suppose that the selling is done for now. We had weeks and weeks of intense selling in these names. That could mean number one, oversold bounces, big ones, or at least stabilization, consolidation until the next catalyst arises. Moving on to the charts analysis, what's going on here, starting with the SPY 30 minutes chart. We hit the resistance of 417.30 and the chart retreated from that point, perhaps gathering more energy to blast higher. Is the energy available? Meaning, are we seeing retail traders and institutionals buying the dip to push the SPY higher? Or even if the retail side and institutionals are absent and not buying the dip, has the selling dried out? Are the sellers done? That would be enough for the SPY to gather energy and start to rally again. Notice that we have a gap open, and the gap at around the very important support level of 412. The chart did not go all the way down there. And when we talk about technical analysis, we talk about charts reaching the gap and then reversing the other way around. On the upside, doing so is a negative, ominous signal that there will be more pain to come. The opposite is true. If the chart goes down all the way to a gap and then reverses higher again without closing the gap, it basically tells us that the chart is not done going higher. In addition, here's another way to look at it. We saw an ABC bottoming formation, and now we are in no man's land, just waiting and waiting between a very important support and resistance level. The support at 412, the resistance at 417.30. Neutral, we cannot make conclusions one way or the other. But from the limited scope of a 30 minutes chart, the bulls appear to have the advantage. Let's zoom out to the daily chart of the continuous contract and see what's going on here. Here is the chart, no new markings or annotations by me. What if I told you that this is an inverse ABC pattern and the SPY will reverse or go down all the way to the support level of 3,960, which is my preferred level to buy the dip, at least my preferred level for a decent support. This outlook will be determined by tomorrow. If the SPY starts to reverse down, then you will know that the possibility of an inverse ABC pattern is becoming more and more likely. And this is the beauty of doing charts. The short-term charts give the advantage to the bulls, the daily chart mixed, but a slight advantage to the bears that we are seeing an inverse ABC pattern. We will know by tomorrow. What about the Qs? 30 minutes chart breaking the support of 326, going all the way down to 323, but recapturing that level before the close. And once again, not closing the gap. You see the gap in the circle in yellow. That has not been closed yet. Reversing before closing the gap, that is a bullish signal. It tells us that the Qs is not done going higher. This is the 30 minutes chart perspective. And the center of gravity remains 323. What about the daily chart, the continuous contract? Once again, no new markings or annotations by me. The chart remains negative, because the negative divergence in the RSI persists. We are still seeing a loss in momentum from the MACD indicator. But on the positive side, the chart continues to hold onto the support of 13,300. I want you to pay attention though to the market symmetry, because we've seen corrections for the Nasdaq a few times this year and in the past year. The most recent correction was proven to be another dip to buy. So is this correction yet another dip to buy? Here is the market symmetry. We saw a decline, consolidation. This is last time around, by the way, late February, early March. A decline, consolidation, followed by another leg of declines, consolidation, and then recovery. In the current correction we're going through right now, the chart also made a leg of declines, consolidation, followed by another leg of declines, and then consolidation/recovery. Will that continue, just like we saw during the last correction, and this will be proven to be yet another dip to buy? That remains to be seen. But we're not talking about weeks or even days. We're talking about as soon as tomorrow. If we see more big gains for the Nasdaq tomorrow and the day after, then this could be another dip to buy. However, this time around, the fundamentals are a little different. meaning the CPI report, the employment data. We're getting more and more solid information that inflation is here, and these names in the Nasdaq should be out of favor, unlike a couple of months ago. So this is an important difference that we have to distinguish in market symmetry between the last correction and the current correction. What about the IWM 30 minutes chart? Gapping lower in the morning, capturing support from where? The support level of 218, and then blasting higher all the way to the end of the day. The Russell 2000 had a healthier rally today than the Nasdaq and the SPY, and the reason is the mania names, specifically AMC, continues to blast higher and higher impulsively. So it is very hard to take the IWM seriously because it has become a meme ETF. But the longer dated charts give us a better perspective. In this case, the daily chart of the RUT, the Russell 2000. The Russell has been in consolidation range all the way till the beginning of the year, going nowhere. We have the critical line of 2,264. The chart loops around this line, up and down, closing the week above that line, and the bulls have the advantage. Closing the week below that line, and the advantage turns to favor the bears. We have the line in the sand of 2,100. So you got your popcorn, you're watching the show, you're watching the battle, back and forth. But you have the line in the sand closing below that for the week, and the bears will have the advantage 100%. All of this consolidation is a gathering of energy. This energy will be released one way or the other very impulsively. The IWM for now is a watch and see type of chart. What about the Dixie, the dollar index? I'm looking at the MACD indicator. We're seeing weakening in momentum here, but I'm giving the dollar the benefit of the doubt. It is gathering energy. It is prepping for a massive pop higher. Perhaps it needs to go down all the way to 90, capture that support, triple bottom, and then bouncing higher. Could that be what the dollar index needing to start a rally? And if the dollar index bounces higher, could that be a result of the resumption of the correction in the stock market, liquidation, raising cash, pushing the Dixie higher? Could be. What about gold? Gold is breaking out here, releasing the energy it has been gathering by consolidating between 1750 and 1800. The dollar remains muted. Therefore, gold is rallying, and yields also been weakening for days now, although we saw a mini rebound today. So could that be a reason to pause the rally in gold? Suppose if yields continue to rise higher, this rebound continues and yields go past 1.7%. Will that be a cap on the rally for gold, the breakout rally, or will gold continue to rise higher along with yields? Because that will be a critical indicator of the change in sentiment regarding inflation. Here is the chart for yields, the 10-year Treasury yield, going all the way down, breaking the support level of 1.622 basis points, but bouncing higher in or around that level. The question is, will the momentum continues? And the critical level to watch here is 1.7%. The moment yields break above 1.7%, the market will start to panic once again regarding inflation. But so long as yields continue below 1.7%, then the market could buy the transitory argument, or at least put the inflationary worries in the back burner. So we're watching whether this bounce is sustainable or not, whether it will take us all the way to surpass 1.7% or not. A reversal in yields overnight or tomorrow or after Papa Jerome releases the minutes on Wednesday will be critical, because yields going down, that will be the green light for the recovery in the Nasdaq and the mania names. What about bond prices, the TLT? Weekly chart this time around. What's going on here? If yields are set to break higher, surpassing 1.7%, then the TLT will break lower. We have a bear flag formation, and if that bear flag plays out, we will see more pain in the TLT, significant one, and the line in the sand is 134.5. Closing the week below that, you will know right away that yields will surpass 1.7 and perhaps go all the way to 2%, we will see another flush down, a nasty one for the TLT. What about the VIX? What's going on here? Rebounding higher, but not recapturing the level of 20. So does this mean that the VIX is lacking the energy to close above 20 and recapture that level for support? Or is the VIX just recocking the gun to prepare for another blast out higher? I showed you the weekly chart last night. The weekly chart says that there is more momentum to be released for the VIX to rise higher if that is needed. So we have to combine the chart of the SPY and the VIX. Remember the chart of the SPY futures. We're watching whether there is an inverse ABC formation, and we will know that as soon as tomorrow. And if there is an inverse ABC formation, then the VIX is just recocking the gun and it will blast higher again. If the SPY continues to rally higher, specifically significantly, not just tomorrow, but after the FOMC meeting, then we will know that the VIX is lacking the energy to recapture 20 as support, meaning that the complacency is still here and the appetite for protection and insurance is not here yet. The sentiment is very important. Until and unless the sentiment changes from bullish to bearish, you could see lots of dip buying across the market. And another name that is very important for the sentiment in the market is Tesla. We'll talk about that in a little bit. But before we do that, let's talk about Apple. 30 minutes chart, gapping lower, so we have yet another gap here, a smaller one, going all the way back to the support of 125 and rebounding higher at least at the end of the day. Can we read anything here, positive or negative? Not really, but when we zoom out to the daily chart of Apple, the negative divergence in the RSI persists and the chart remains negative until and unless we fix the negative divergence in the RSI and we see the MACD indicator curling upward, indicating that the momentum is building up to create another rally in Apple. And here it is. What about Tesla, the souffle? What's going on here? Tesla slightly lower, but again, it is reaching oversold conditions. Not severe ones where you have to bounce from this level, but close enough. Perhaps we can see more pain here, going all the way down to my support level of 540. And by the way, Tesla could rebound at any point right now. It doesn't have to go down all the way to 540. But to my discipline, I wouldn't buy calls for Tesla until and unless we reach 540 and we bounce higher from that level, capturing and confirming the support. Other than that, I'm not interested, even if the name rebounds earlier and before 540. That's of course the hopeful side, the bullish side, that at some point the selling will stop and we will see a rebound higher. But the sentiment against Tesla is changing. We have the Big Short announcing that he is bidding over $500 million against Tesla, buying put options. And that will embolden the bears that, hey, we have a validity to our theory, to our thesis against Tesla. We have somebody who's smart and proven in Dr. Michael Burry, the Big Short, betting against Tesla. That tends to embolden the bearish bets against the name, and you see a flush down, a panic-like selling. We will see. But 540 is the number to watch, at least for me. What about the tulip market? Let's see what's going on with the mania, the cryptomaniacs. What's going on? BTC, the biggest tulip of them all, going all the way down to my target of 42,000 and then rebounding higher. The market is trading as I speak, so perhaps we have an update already. By the time the video goes out, the chart will change. But is 42,000 a guarantee that Bitcoin will rebound higher? Not really. But take a look at the RSI, daily perspective, reaching oversold conditions. Bitcoin should be able to at least rebound slightly in the short term from 42,000. If that doesn't happen, then that is a signal that the weakness in Bitcoin is just starting. And once you surpass and close below 42,000, you will open the floodgates for Bitcoin to have a nasty historic sell-off. What about the other tulip, Doge? What's going on here? Consolidating for now, but going all the way down to my support level and bouncing to the penny. Once again, you think the Maverick of Wall Street picks his numbers randomly? Think again. Doge consolidating and waiting at the mercy of what? For Reverend Elon Musk to start tweeting again. Whether he's going to crash the thing or boost it higher again. This is tweet-based investing. This is not real investing. You're investing at the mercy of one man's tweets. Here's another tulip we talked about yesterday, Ethereum, ETH. It is starting to weaken significantly. We have a crossing in the MACD indicator. We have a negative divergence in the RSI, signaling a loss in momentum. And this loss of momentum, by the way, is the first loss of momentum, significant one, going all the way back to March. since this massive rally in Ethereum started. We have the Fibonacci levels, and we are eyeing the level of 2,900 for support. But once again, I wouldn't be buying the dip in this thing, playing a rebound until we go all the way to 2,500 and then reassess. But once again, the bulk of the gains in Ethereum has been already pocketed. Lastly, I want to show you charts of the different ETFs and sectors of the market, starting with the XLK, the technology sector. Notice that after the dot-com bubble crash, the tech sector was consolidating and doing nothing at all. It was a garbage sector, hated, unloved, and the sector did not recover the dot-com highs for years and years to come. Matter of fact, over a decade. And by the way, what triggered the massive rally in the technology sector? The sentiment started to change around the year 2009. What happened in 2009? The financial crisis and the beginning of the QE era, aka the cocaine operation. Lower interest rates and flooding the market with more and more cocaine. Therefore, the monetary policy said, pay no attention to valuations and pay attention to future earnings. Which companies are quote unquote the future bro technology companies? And the tech sector had this impressive, massive, historic rally, and to be honest, an impulsive rally, all the way till we stand today. What's going on today? A reversal in the regime. The easy money policy is starting to create inflation. Finally, and in response to this inflation, the monetary policy will tighten the tapering, etc. Remove the cocaine out of the market, and perhaps the technology sector has already topped. Now, contrast that with the XME, for example, the metals, the materials ETF. We saw a small correction last week along with the tech sector. Everything went down after the CPI data, but look at what happened right after. Buying the dip aggressively, and the XME recovered all of the losses from the so-called correction last week. Zooming out for a bigger perspective from the monthly chart, look at what's going on with the materials sector, the opposite picture of the technology sector. It has been on a downturn all the way back to 2009 when the easy money cocaine operation policy started. But we have a change in regime. We have the double bottom breaking the descending line for the first time in a very aggressive manner. What you're looking at right now is not just a rally, is not just temporary, it is not just transitory, it is a change in regime. Yes, it has been an impulsive rally in metals and materials, and we will see corrections, no doubt. But at the end of the day, perhaps it is time to place technology out of favor and place traditional sectors of the market, the likes of materials and financials, in favor, because the trajectory for the macroeconomic environment and the monetary policy is supportive for sectors like materials, not technology. Enough said. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have housing starts. That will be important to watch, along with corporate earnings, because we have Walmart, Home Depot, Macy's, and Take-Two. And by the way, Riot Blockchain did not report today. They're reporting later, May 28th. Anyhow, before I end the video, the headlines of the day segment will resume starting tomorrow, because today was tax day and I was busy doing work. Lots of work. So tomorrow, we'll be back with the headlines of the day, and we will talk in details about Tesla, Reverend Elon, the pumps and dumps. So stick around for that. But for now, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.